You check your account balance, $20,000. You feel good, you feel safe. But somewhere inside a system you'll never see, a bank just quietly recalculated everything it thinks about you. Not because you're rich, not because you're a threat. The real reason is far stranger, and it has almost nothing to do with the number itself. Here's what you think is happening. You saved diligently, you skipped the coffees, you built a cushion for emergencies. The bank sees a loyal customer and smiles. That's the story you've been told your whole life. It's comforting. It's also almost completely wrong. Banks don't actually want your money sitting still. They want it moving. Every dollar you deposit becomes raw material for something else entirely, something you were never meant to think about too hard. Have you ever wondered what a bank actually does with your savings the moment it lands in your account? It lends it out, almost immediately. This is called fractional reserve banking, and it's the quiet engine behind the entire financial system. For every dollar you deposit, the bank is only required to keep a small fraction in reserve. The rest goes out the door as loans, mortgages, credit lines, and business capital. Your $20,000 isn't a trophy sitting in a vault. It's a lever already pulling on a dozen other people's lives before you've even finished your coffee. Economist Milton Friedman spent decades studying exactly this mechanism. He showed how the money supply expands not through printing presses, but through this quiet multiplication of deposits into loans. $1 becomes several dollars of lending capacity across the system. Your paycheck becomes someone else's mortgage down payment. Your savings becomes someone else's small business loan. You didn't sign up for this. Nobody asked you. But it happens anyway every single time you deposit money into a checking account. So why would a bank panic at $20,000 specifically? Why not $10,000? Why not $50,000? Here's the reframe. It's not the amount. It's the behavior pattern attached to it. Banks build predictive models around deposit behavior. They track velocity, how often you move money, how often you withdraw it, how often you let it sit untouched for weeks at a time. A $20,000 balance that stays flat for months looks completely different to an algorithm than one that fluctuates constantly between $0 and a few $100s. It signals something specific, financial stability. And financial stability, strangely enough, is exactly what makes a customer harder to profit from. Think about that for a second. A bank doesn't make its real money from your steady balance. It makes money from your instability. Overdraft fees when you slip below zero, interest on revolving credit card debt that never quite gets paid off, late payment penalties on missed due dates, minimum balance fees on checking accounts that dip too low too often. The entire retail banking model historically has leaned on customers who are just slightly financially unstable, not broke, not wealthy, stuck in the middle, cycling small amounts of debt month after month. Psychologist and behavioral economist Richard Thaler documented how small nudges in account design shape spending behavior over years of research, minimum balance requirements, fee structures buried in fine print. Even the placement of a balance number on an app screen, timed to appear right before a purchase decision. These aren't neutral design choices, they're incentives, built to keep your money in motion in ways that generate revenue for someone other than you. When you break that pattern, when you hold a stable, growing balance instead of an unstable one, you become a different kind of customer. Less profitable in the short term, harder to predict in the long term. Here's the twist nobody explains, and it's the part that actually matters. Once you cross a certain threshold, banks stop trying to extract fees from you and start trying to extract your money in a completely different way. Once your balance is high enough to be meaningful but not so high that you look like an institutional client, you enter what the industry quietly calls the mass affluent bracket. And that bracket gets a completely different kind of treatment. Suddenly you start getting calls about wealth management services you never asked for. Suddenly there are offers for premium checking accounts, cash bonuses for switching banks, invitations to speak with a dedicated financial advisor. Nothing about you changed as a person. The number just crossed a line that shifted how the system reads you. Have you ever noticed how the moment your savings crossed a certain point, your bank's app started suggesting investment products it had never mentioned before? That's not a coincidence. That's a threshold being triggered somewhere in a database you'll never see.